Imagine finishing a hard month of work and receiving an email stating you've been paid $2,000. You check your bank account, but only $1,400 is actually available for use. That discrepancy is caused by three distinct categories of taxation. Income tax targets what you earn, sales tax hits what you spend, and capital gains taxes your investments. Mandatory payroll deductions also include Social Security and Medicare. These function as forced mechanisms for retirement savings and a collective health insurance pool for the elderly or those with serious medical needs. These payments maintain the infrastructure of the country. They fund the roads you use, the schools in your community, and the regulatory agencies that ensure the safety of the food you buy. Since these taxes are a fixed environmental cost of living in society, they serve as the starting point for your financial projections. You cannot accurately calculate your real net worth without first accounting for this inevitable drain on your capital. To protect what remains, most people turn to a bank. There is a common assumption that your cash is sitting in a reinforced vault. In reality, the bank has already moved those funds elsewhere. Banks operate through fractional reserve banking. When you deposit $1,000, the bank keeps a small percentage and lends the rest to other borrowers at a higher interest rate. This model relies on the assumption that everyone will not attempt to withdraw their entire balance simultaneously. The 2008 collapse demonstrated how quickly the system can crumble when that collective trust disappears. Even in a stable bank, cash faces the slow erosion of inflation. While the number on the bill remains the same, its purchasing power quietly decays. Over time, that same $5 buys less gasoline and fewer groceries. This loss of value occurs when too much money chases a limited supply of goods. If thousands of people want the same television and the store only has half that amount in stock, the business will raise prices to match the demand. To slow this process, the government raises interest rates. This makes borrowing more expensive, which reduces overall spending and forces the economy to cool off. Relying on a savings account provides a feeling of safety, but inflation ensures a steady loss of true value over the long term. Mastering your finances requires understanding interest as the price of using someone else's money. It is essentially rent paid for the right to hold capital that isn't yours. Line A shows simple interest, a flat, steady, linear growth over 30 years. Line B tracks a 20% credit card. Miss a payment, and compounding interest creates massive debt. But investing at 7% compound interest reverses this, creating exponential growth that dwarfs savings. Lenders determine which interest rate you pay by looking at your credit score. This three-digit number tracks your payment history and how much of your available credit you are using to decide if you are trustworthy. Interest acts as a multiplier that can work for or against you. Eliminating high-interest debt is a prerequisite for successfully utilizing compound growth. Investing is the process of putting your money to work. It allows you to move beyond trading your hours for a paycheck and start using your existing capital to generate more money. Bonds are one of the primary tools for this. You are loaning money to a government or corporation in exchange for fixed, predictable interest payments. This provides a stable anchor for a portfolio. Stocks and index funds involve buying fractional ownership in companies, offering high potential for compound growth, but they require the necessary discipline and ability to ignore the short-term volatility and occasional messes of a market crash. Real estate offers a tangible asset and the ability to use a mortgage as leverage. However, it requires high initial capital and the active effort of managing a physical property. This matrix breaks down the trade-offs for each asset class. You are balancing the risk involved against the amount of active effort required and the historical yield of the investment. No asset is perfectly safe while offering high returns. Your strategy depends on your specific tolerance for risk and your planned time horizon. The concept of money is a social construct. A dollar bill has no more inherent legitimacy than a stick. It only functions because society collectively agrees to trust its value. Even gold is only valuable because humans decided it is. It's rarer than a common rock, and we project worth onto that scarcity. Generating large amounts of wealth requires creating significant value for others. By solving a complex problem or providing a tool that millions of people want, you earn the right to collect a portion of that value. Time is the only asset that is strictly non-renewable. While everyone starts with a certain amount, no one knows exactly how much they have left. To build wealth, you must use your time to acquire leverage. This allows your hours to work for you through your investments, rather than constantly trading your time for a single paycheck. This quadrant chart maps your options by comparing active effort against potential for compound growth. A traditional savings account sits in the bottom left. It takes very little effort, but it often results in negative real growth after inflation. It is useful for emergencies, but ineffective for building long-term wealth. Real estate occupies the top right. It offers significant growth potential, but only for those who are willing to treat their investments like a labor-intensive second job. Index funds sit in the bottom right quadrant. This allows for high compound growth over the long term, with almost no daily effort. Building wealth is a process that requires consistent patience over several decades. Compounding takes time to reach its full potential, making the decision to start early more important than luck or timing.